One of the biggest blunders beginner investors make is choosing a stock purely because of its high dividend yield. Dividend investors are a popular term for both new and experienced investors who seek companies with high dividend yields. However, investing in stocks only for dividends is almost always a bad idea for anybody looking to build long-term wealth. In this video, we will discuss Warren Buffett's views on dividend investing. So stay tuned till the end, like, subscribe, and share this video. Warren Buffett, the CEO of Berkshire Hathaway, is widely regarded as the most significant investor of all time. With his over 80 years of investing experience, he now has a net worth of over $103 billion as of August 2022, making him the 7th wealthiest person on earth. We all know that Buffett's investing success is because of his strategy of owning company stocks he only knows, how it operates, and the simplicity of it. Berkshire Hathaway, along with its other companies, does not pay many dividends. According to Warren, investors will profit more from their decision not to pay dividends as long as they can use every dollar they keep. This will generate more than $1 of value and market value over time. He said, "We only keep your money if it becomes more valuable by holding it than it would be if we handed it to you. If we can generate more than $1 of market value for every dollar we keep, it doesn't matter whether you take that dollar out by selling a small amount of your stock or keep it in." If you understand what Buffett said, this makes a lot of sense. In an interview, Warren Buffett also said, "We hope that in the larger scheme of things at Berkshire Hathaway, we can sensibly employ the money that the companies create for us, which we have done so far, and we believe the prospects are relatively high that we can continue to do so. However, that criterion, plus the potential for stock repurchases, should serve as the guideline for dividend policy. But the question should be whether a dollar retained in the company is worth more to the shareholder than a dollar distributed. You must first realize the rationale for a company paying a dividend to completely understand Warren Buffett's assertion in this video. Kroger is a business in which Warren Buffett has a significant amount of shares. Let's take Kroger to illustrate why a corporation may pay a dividend and why the decision to do so could be detrimental to long-term investors. By sales, Kroger is the second largest general store and the biggest supermarket chain in the US. In 2020, Kroger had a profit of almost $2.6 billion. While it is undoubtedly a large sum of money, what should the company do with its profits? To start, Kroger may put some of its earnings back into the business. This might be done by remodeling outdated storefronts or expanding the company by launching new locations. These actions would be categorized as capital expenditures, which is just a fancy accounting term for investing in the corporation's business operations. There are a few additional things a corporation may do with any extra money after putting it back into the operations of the company. Dividends are monetary payments made to the shareholders in return for their ownership of the company's shares. By paying out $534 million in dividends in 2020, Kroger was able to accomplish this. As a result, the shareholder would have gotten 50 cents in dividends for each Kroger share purchased in 2020. At first sight, this might not seem like much, but keep in mind that at some time in 2020, Kroger stock was trading for about $30 per share. Kroger may buy back shares with its extra money as well. When a corporation buys back shares, it lowers the number of outstanding shares, giving each share a more significant ownership stake in the business. In 2020, Kroger repurchased $1.3 billion worth of stock similarly. Now that we know why a company can decide to pay dividends, the main argument is whether or not dividends could be detrimental to investors. The two main descriptions for why dividends could be bad for a long-term investors are: First, businesses occasionally provide dividends rather than investing in their businesses. Companies use this to jeopardize their long-term viability to pay dividends in the near term. This is the main point Warren was trying to get over. Going back to our Kroger example, it would not have been a good idea for Kroger to provide a sizable dividend while it was a smaller company experiencing rapid growth. The money would have been better used if it had been invested in the company's growth, expansion into other cities, and long-term success rather than paid as a dividend. This holds for Amazon, another stock under Berkshire Hathaway's management and owned by Warren Buffett. To continue growing, whether via the construction of new warehouses, the employment of more workers, or the expansion of Amazon Web Services, Amazon needs every dollar it can obtain. Amazon may make investments in some alluring industries to grow the company. In light of everything said above, Amazon shouldn't start paying dividends until it has more cash than it can use to generate sizable returns for investors. Another thing is that most companies cannot continue very high levels of dividend payout, which takes some time for new investors to understand. Even though the company's real performance has changed, management is still under pressure to increase dividends. Dividend-trapped firms are those in which the payment eventually becomes so enormous that the company is unable to continue paying the hefty dividend. Due to the firm's extremely high dividend yield, novice investors will purchase shares only for the management to drastically reduce the payout once the company is unable to continue paying the dividend. This is what has recently happened with AT&T. Since the company's dividend yield was around 5 times higher than the normal S&P 500 company, several investors bought the shares. However, as soon as the company cut its dividend in half, and the stock price plummeted, dividend investors lost much more money as a result of the drop in stock price than they did from the few dividend payments they received. Even though dividends might be advantageous for investors, it makes whole sense for a company to decline to pay them. Take into account how much more quickly a company may develop, pay off existing debts, cover unanticipated expenses, retain more revenues, and gain market share by reinvesting more money in the crucial area of the company to maintain and surpass former or current growth. Dividend investment differs significantly from looking for large yields. Dividends aren't always a terrible thing. Do your research on dividend payer and don't just buy because the yield is high. Think of yourself as a portfolio manager or a Berkshire manager. Reinvest any profits received by acquiring further shares. Different investors each with distinct objectives and approaches. However, always remember the Buffett rule. Focus on 1 or 2 truly great ideas. Investors must have a laser-like focus on only their very best ideas that fit their personalities. Buffett said there is a difference between successful people and really successful people. Really successful people say no to almost everything, ignore the unimportant, and concentrate on the important. I hope you like this video. If you do, it would be kind of you to share this video with your friends and family. Also, don't forget to hit the bell icon so you'll be updated whenever we have new videos. This is your 3 Towers Investing channel. Thank you for watching and see you soon.